Hello, and welcome to our Correcting Salary Overpayments webinar. I'm Trish, your host for today. For today, please use the question icon in the toolbar at the top of the screen to ask a question related to correcting salary overpayments. We'll answer as many questions as we can during the webinar. For any other tax-related questions, please call the Business Inquiries line at 1-800-959-5525. Let's get started. Today, we'll talk about what is a salary overpayment, how to correct a salary overpayment, how to refund CPP or EI contributions. Let's start by defining a salary overpayment. A salary overpayment happens in one of two situations. In the first situation, a clerical, administrative, or system error led to an employee being paid more than what they were owed. In the second situation, an employee did not perform their duties or fulfill a contractual obligation, and yet they had received payment. In other words, a salary overpayment occurs when an employer accidentally pays someone more than their salary, or when someone does not do a job they were paid to do. If there has been a salary overpayment, the employer decides if the employee has to repay some or all of the salary, wages, or other remuneration overpayments. As well, it's important to note that in the event an employee does not repay the salary overpayment they received in error, the overpayment and corresponding deductions must still be included on the employee's T4 slip. Now we'll walk through how to correct salary overpayments. Let's start with the first situation, an accidental overpayment. Employers can elect to have the employee repay the net amount of the salary overpayment, which is gross pay less source deductions, if all of the following conditions are met. The overpayment was a result of a clerical, administrative, or system error. The business is actively operating. Prior to making this decision, the employer did not issue a T4 slip with the employee's correct earnings with the salary overpayment removed. It is no later than 3 years after the end of the year in which the salary was overpaid and the employee repaid or arranged to repay the net amount of the salary overpayment. The election is made according to the following established procedure by excluding the salary overpayment from an original T4 slip or amending the T4 slip to remove the overpayment and reducing any corresponding deductions that were withheld and remitted. In this situation, no form is required to make the election to choose this route of correcting this type of salary overpayment. Let's look at an example of the first salary overpayment situation. Lee is a full-time employee at 123 Lumberyard. Last week, she received twice her paycheck. Lee then received a notice from her employer that there was a glitch in the company's payroll software and that the overpayments would be corrected in the next pay cycle. In this example, the salary overpayment would fall under the situation where an employee is overpaid due to a clerical, administrative, or system error. If this was less than 3 years before the overpayment and all the other conditions, such as the business still being operational, are still in effect, this would qualify for a situation where 123 Lumberyard could elect to have Lee repay the net salary overpayment. If the employee repaid or arranged to repay the salary overpayment before the original T4 is issued, the employer must not include the following on the employee's T4 slip: salary overpayment, box 14, income tax deducted, box 22, CPP contributions, box 16, EI premiums, box 18. This procedure would likely be the case in Lee's accidental overpayment, as she was notified the week after the overpayment took place. Even if the week was the last pay of the year, it is highly unlikely that the employer would have issued her T4 in the first week of January. If the employer already issued an original T4 slip for the year the salary overpayment was made, they must prepare an amended T4 slip and reduce the following by the amount of the overpayment: total employment income, box 14, income tax deducted, box 22, CPP contributions, box 16, EI premiums, box 18, insurable and pensionable earnings, box 24 and box 26. If Lee's employer noticed the error and notified her of the accidental overpayment 2 years after it occurred, 123 Lumber should still amend the T4 in the same manner. Whether the employee's earnings are corrected before or after the original T4 is issued, if the corrected earnings are above the maximum insurable pensionable earnings, the employer must still ensure that the maximum insurable pensionable earnings, as well as the corresponding EI CPP deductions, are reported on the employee's T4. Now that we've gone through how the repayment of net salary works, we can move on to how and when you would handle a gross salary correction. Employees should repay the gross amount of a salary overpayment if either of the following apply. The employer did not elect to have the employee repay the net amount of the salary overpayment, and the conditions to repay the net amount of the salary overpayment are not met. To go back to Lee's example, Lee would have had to repay the gross salary if 123 Lumber had asked her to repay the gross instead of net salary. Lee would also only have to repay the gross salary if another requirement for a net salary repayment wasn't met. An example of this could be if 123 Lumber took 5 years to notify Lee of the salary overpayment, which would not meet the net salary repayment requirement of having the salary overpayment corrected within 3 years of the year the overpayment happened. When a gross salary repayment is the action taken to correct an accidental salary overpayment, the employer must do the following: prepare an amended T4 slip for the employee. Use the CPP, EI, and income tax deduction amounts from the employee's original T4 slip, but reduce the employment income in box 14 by the amount of their salary repayment. And, if necessary, amend the insurable earnings in box 24 and pensionable earnings in box 26 to agree with the reduced employment income that will be reported in box 14. We've seen what to do when a salary overpayment correction is due to a clerical, administrative, or system error. Now we can talk about the second salary overpayment situation, when an employee did not perform their duties or fulfill a contractual obligation for which they had received payment. Employees should repay the gross amount of a salary overpayment if all of the following conditions are met. The employee did not report to work. The employee is on a leave of absence. The employee received a payment during the leave period that they would normally be entitled to under the terms of their employment contract or collective agreement. The employee's circumstances have changed and is no longer entitled to salary or wages. For example, Juan works for 123 Baking Stuff Company. The company noticed that Juan did not show up to work at the bakery the previous week, but he had already received payment for the week of work. 123 Baking Stuff Company proceeds to reach out to Juan about the issue to talk about how to proceed with repayment. In this example, since Juan was paid for work he did not do, the type of salary overpayment is from an employee not performing their duties or fulfilling a contractual obligation of which they had received payment for. Where the salary overpayment is made because the employee was paid for work they did not do, if the employee repays the overpayment, the employer must include the overpayment and corresponding deductions on the employee's T4 slip, not adjust the slip or the payroll records to reduce the total employment income or source deductions by the amount of the repayment. Provide a letter to the employee confirming the following information: reason for the overpayment, date the overpayment was included in the employee's income, date and amount of the repayment. Now that we have gone over salary overpayment corrections, let's go over how an employer can request a refund of the CPP and EI contributions afterwards. An employer can file Form PD-24 to request a refund of the employer's CPP and EI deductions if the employee repaid the gross salary in an event where the overpayment was due to a clerical, administrative, or system error. CPP can be refunded up to 4 years after the end of the year in which it was deducted. EI can be refunded up to 3 years after the end of the year in which it was deducted. This means that for Lee, her employer could only request a refund of her CPP and EI contributions if she had been asked to repay her gross salary rather than the net salary amount. In Juan's case, since the salary overpayment was not due to a clerical, administrative, or system error, a refund of the employer's contribution to CPP and EI cannot be requested. Today we covered the following items. What is a salary overpayment? How to correct salary overpayments in the event a clerical, administrative, or system error led to an employee being paid more than their salary, or an employee did not perform their duties or fulfill a contractual obligation of which they had received payment for. How to request a refund of CPP or EI contributions after a salary overpayment. Tax administration is as complex as life itself. If the content today doesn't quite fit your situation, please visit our website. Visit canada.ca/CRA-liaison-officer to get free tax help from a liaison officer. Call CRA's Business Inquiries line at 1-800-959-5525. You can also go to canada.ca/CRA-videos, where you will find all our business webinars. We've come to the end of our webinar. Please click on the survey icon in the toolbar at the top of the screen to fill out the evaluation form for this webinar. Thanks for joining me today. I hope it's been helpful. Stay tuned for more webinars in the coming months. Goodbye.